IPC is an oil and gas exploration and production company and a part of the Lundin Group. Mike Nicholson, you are the CEO of the company. Could you please give us an introduction to IPC?
Yeah, thank you, Matilda, and a big thank you to Pareto TV for giving us the opportunity to talk about the exciting IPC company and our prospects. And I guess if I'm looking at IPC from an investor perspective, I think IPC is extremely attractive when you look at us in terms of both the free cash flow generation that the company has and the yield, the free cash flow yields that we have, or also through the value lens. I think to value-based investors, also a very, very attractive proposition. And if I touch upon for a minute on the cash flow proposition, we've put together a very conservative capital budget this year. So $37 million, more than a 50% reduction from last year. And that was really put in place to allow us to be much more resilient to lower oil prices. And when we look at oil prices in the last months around that $55 to $65 per barrel range, it means that IPC this year, should generate somewhere between $100 and $150 million of free cash flow off our stay flat production of around 42,000 barrels a day. And that's about a 20 to 30% free cash flow yield for this year. But also looking beyond that, if you take a 5-year outlook for the business, with a pretty modest sustaining capex of around $4.50 per barrel, again, between that same $55 and $65 per barrel, we're going to generate somewhere between $600 and $900 million of free cash flow on that 2P do nothing more scenario. And just to put that in context, our current enterprise value is around $800 million. So at the higher end of that forecast, all our debt will be paid off and we have the capacity to buy back every single share. And we'll still have 2/3 of our reserves, and investors get 1 billion barrels of discovered contingent resource for free. So I think cash flow wise, obviously, that screens extremely favorably. And I think when you look at it through the valuation lens, obviously oil prices collapsed last year. And when we run our 2P reserves on our independent third-party reserves price deck, they're valued at around $1.3 billion. And with the stock today trading with a market cap of around 500 million, that's a 60% discount to the 2P value of our assets. And it's on a pretty conservative oil price assumption. That's $47 a barrel for this year, rising to $58 per barrel in 2025. And it doesn't include a single dollar attached to our 1 billion barrels of undeveloped contingent resources. I think investors, whether you're looking at through the cash flow and yield lens or the valuation lens, I think IPC offers a very attractive proposition for a wide array of investors.
And I would like to ask you about the oil price collapse last year. How was it to lead an oil company when the oil price is collapsing?
Yeah, I mean it's never the best year in one's life, but I think the good thing is we have got a phenomenal team of people, and we're in a more favourable position, I guess, than some, because we operate all of our assets. So we operate our assets in Canada, in Malaysia, and in France. And what that really did allow us to do is move very swiftly, take some pretty decisive action. We dramatically reduced our capital expenditure budget by more than 50%. So we took out $80 million of investment. And that really put us on a much more solid footing. And what we were able to do is still generate positive free cash flow last year, just under $10 million, notwithstanding the turmoil that we faced. So I think swift and decisive action, great teams on the ground, complete reset of our short-term business plan allowed us still to generate positive free cash in a year when oil prices were just marginally above $40 per barrel.
And looking forward, how is the outlook now?
Yes, I think obviously the outlook is significantly improved from last year, and I think OPEC and the other nations participating in the voluntary production arrangements have done an incredible job of moving to rebalance the markets. It was never going to be something that would fix itself in a short period, but if we look at the global inventory levels, we're now starting to move back into the zone where we're moving towards that 5-year average. There was a drawdown of inventories of about 1.6 million barrels a day in Q4, and that had increased to 2.2 million barrels a day in the first quarter of this year. And I think when you look at global balances, we're still about 140 million barrels above the 5-year average. But at that Q1 burn rate, it takes only 2 months to get through that. So I think in terms of that overall inventory liquidation, we're heading in the right direction. I guess the second big thing that's going to solidify the recovery is the recovery in demand in the second half. And when you look at the IEA numbers, they're looking at an increase in global demand this year of just over 5 million barrels. But I think importantly, what they're seeing is by Q4 this year, that's expected to be up at 99 million barrels a day, which is getting back to the pre-COVID level. So I think there's been a very measured, balanced reaction to retain that supply. And I think as we see demand recovering through the second half of this year, that's going to put the recovery on a much more solid financial footing, as opposed to holding back some of those barrels artificially.
Energy transition, environmental questions, and ESG issues are an important topic right now. How do you work with those kind of questions?
Yeah, I think it's part and parcel of all Lundin Group companies. Sustainability is not new to any of us. We've been dealing with this since the Lundin Energy was formed back in 2001. And I think IPC is a younger company. We took a step change in our ESG and non-financial disclosure reporting last year. We published our first sustainability report during the third quarter, and we've formed key partnerships with the Lundin Foundation that are real experts in community development projects across the globe. That's going to be a big resource for us as we continue to expand on that strategy. And we also partnered with First Climate, that are an expert in finding and sourcing and third-party verifying carbon offset projects. And in that sustainability report, we made a very tangible, firm commitment that over the next 5 years, through both operational efficiencies on our assets and investing in carbon offset projects, that we'll be reducing our net carbon intensity by 50% over the next 5 years. So firm target, firm timeline, and we're working with First Climate in order to secure those carbon offsetting projects. And I think like any company now, regardless of which sector that you operate in, a very clear ESG strategy has to go hand in hand with your operational delivery as well.
Yeah, I think so too. I agree. Thank you so much, Mike Nicholson.
Thank you very much, Matilda, and to Pareto.